So we'll start. Okay, so settle down, please. So now we have had our meals and we are ready to sleep. Okay, so we'll go to the next part. Okay, so this is arguably one of the most important parts, I would say, within the PP section, which is site restoration. So there are two standards which are connected over here. There is Ind AS 16 and Ind AS 37. 37 is on provisions and contingencies. Now what do you mean by site restoration expense? What is meant? It can be called as dismantling, it can be called as decommissioning, or it can be called as site restoration. We will call it as SRO, site restoration obligation. But what is site restoration actually? Okay, so when I acquire a building, let us say I am constructing a nuclear plant. Now nuclear plant has certain radioactive risks attached. So the government gives me permission to construct a nuclear plant. So let's say I spend 100 rupees to construct that plant. Should that be capitalized along with the cost of the plant? Of course, that is directly attributable construction cost. Now the government says that you can use this plant, let us say, for 10 years, and 10 years later you can't just abandon, or whatever, you can use it for 5 years, 10 years, 15 years, whatever. But the moment you decide to discontinue using the plant, you can't just abandon it and leave it. You will have to dismantle it and restore the site in the condition it was prior to that. That is when I gave you, because if it is abandoned, people might kind of venture into it and there might be some life hazards. So you are under an obligation to dismantle. But when do you have to dismantle? Do you have to dismantle immediately? No, you have to dismantle later. If you decide to discontinue after 5 years, then after 5 years, after 15 years, then after 15 years, after 10 years, then 10 years. Let us say we have decided that we are likely to dismantle, let us say, after 10 years. So should you create anything now, or should you wait for 10 years? We should create now. We have come well prepared. Why should you create a provision now? You are going to spend money after 10 years, right? What is the logic of doing anything right now? What is the underlying logic behind creating it now? Because it is certain. Okay. So let us say we are pretty sure, we are certain that after 2 years we want to take a loan. We have also entered into a forward contract, let us say, to take a loan. Do you record the loan right now? Why no? Okay. You can say that there is an obligation. What do you mean by obligation? Obligation is something which is unavoidable. When is the obligation born? The obligation is born the moment you construct it. Now, how do we say that? Hypothetically, let us say we decide the very next day we don't want to continue. Is that possible? If we decide the very next day that I don't want to continue, will I still have to dismantle it? Yes. So remember, you might spend money later, but the obligation to spend arises, it is unavoidable. You will have to spend money, if not today, later. But what is the event that gives birth to the obligation? It is a construction. A corresponding comparison to this is what you might have studied in CA Inter for warranty. In CA Inter, did you create a provision for warranty? Let us say Dell sells a laptop today, and it gives you a 3-year warranty. Does Dell create a provision for warranty immediately? Why does it create it immediately? Because the moment I sell it, I give the warranty card, which means technically the very next second, if there's a defect, the customer can come back and you are obliged to repair free of cost. No, you might repair it later, but the obligation arises the moment the sale happens. In a similar way, the obligation to dismantle arises the second the construction is done. And as a result, we don't wait till the time you do actual dismantling. Otherwise, so we are following cash system of accounting. We want to follow mercantile accrual system of accounting, which means the moment the obligation to construct, the obligation to dismantle arises, you will create a provision and you will not wait till the time actual dismantling is going to happen. Are we clear with this? Okay, the obligation over here can be either a legal obligation or it can be a constructive obligation. Ind AS treats legal and constructive on par. What is a legal obligation? It is written in a law or written in a contract that is legally enforceable. If you don't dismantle, people can sue you. But what is constructive obligation? Have you heard about this? Past practices or published policies. You are a very environmentally conscious company. As per your past practices, you have always dismantled. Whether there was an obligation or not, you have always dismantled, which means it gives expectation in the minds that you will dismantle. So will you create a provision? Yes. What is a classic example of constructive obligation? It is like Diwali bonus that you might pay to your employees. It might not be legally agreed. However, as per past practices, you have always paid. So there is a constructive obligation attached. Are we clear with this? Okay, so you will create a provision. Now let us say you spend, so there is an example over here. There is a plant where you initially spent 90 rupees. Now this 90 rupees should be a part of the cost. You are estimating to incur another 40 rupees of site restoration cost in the 10th year. Have you paid anything today? No. But are you estimating that you will pay 40 rupees after 10 years? But is 40 paid after 10 years equal to 40 today? And as a result, will you create a provision? Will you create a provision for the entire 40 at present value of 40? So you will say 40 rupees to be incurred after 10 years is equal to how much today? And thereby you will create a present value. And there will be a discount rate. For simplicity, the discount rate will be the WACC, though it is technically the rate which is a risk-free rate plus the risk attached. And thereby we will usually take it to be WACC. From an FR paper perspective, it will almost always be given to you. Remember, so over here, let's say the discount factor is given to be 10%. So if I do the present value calculation, let's say it comes to around, present value factor comes to around 0.3855 or something. We usually take 4 decimals, 3 also work, but I personally prefer to take 4 decimals for discounting factor. So let's say we take 0.3855. And as a result, if I were to take, let us say 0.3855, then 40 rupees to be spent after, let us say 10 years are going to be worth how much today? Arey chodo, whatever I'm removing. So just take a calculator out. Focus. So you have, let us say, you will have 40 into 0.38. So how much is that? 15.42 or 43, approximately, let's say 15.4. So now when I have to pass a journal entry, what will be my journal entry for this? I will say PP account debit. Now initially I've spent 90. Will that be a part of the cost? So PP account debit to bank. To bank definitely 90 rupees. And I will also have to create a provision. Provision for how much? But where will this provision go? Well, it will be capitalized along with the cost, and hence this is 105.4. So when I look at an asset, someone will say, how much are you spending for the asset? We will say, I'm spending 90 rupees today. But is that the only cost of the asset? No. I'm spending 90 today, but I also have a commitment to spend 40 after 10 years. The moment I buy the asset, I'm under an obligation to dismantle. And as a result, I will create a provision for 15.42, and thereby my true cost of the asset is 105. Why is this very important? Because there might be another project which was available at 100 rupees and there was no site restoration obligation. If I were to compare 90 and 100, I would think 90 is cheaper. But 90 comes with a decommissioning obligation. 100, the other project is in a very barren area. There is no decommissioning obligation. So on the face of it, is 90 expensive or 100 expensive? 100 is expensive, but the true cost of the asset is not just 90. It is 90 today plus 40 after 10 years, and hence translating to around 105.42 in total. So that is going to give you the true cost of the asset. It is the event that gives birth to the dismantling obligation is the construction, and hence you capitalized it along with the cost of the asset. Are we clear with this? Is everyone clear? Any problems here? Okay. Now, what will you, let's say the life of the asset is 10 years. What will you do with the PP? Will it continue to remain at 105? I'll depreciate it, let's say on a straight line basis, 10.54 being the annual depreciation. But what will you do with the provision? Provision also we will depreciate. Take it to zero balance. No, what will you do with the provision? No, no, provision. Now there are three options. We will say blindly, asset is depreciated, chalo, provision also depreciated, take it to zero. Is that correct? Why no? Because I don't have to, I mean, after 10 years, it's not that I'll have to pay 0 rupees. Acha, then I'll keep it as it is, 100, I'll have 15.42. No, I know as a matter of fact, that 10 years later, I have to spend how much? Which means, will I continue to keep this at 15? I will slowly amortize it, or technically called as unwind it. So I was earlier bound. I was earlier something of 40 was actually tied up and made 15. Slowly, I will unwind and reach up to 40. Are we clear with this? Now, as each year passes, I will unwind it. This unwinding cost is in the nature, like on 105, I will depreciate. It will go in the heading of depreciation and amortization. How will I unwind? Well, I have taken a present value factor. I have taken discounting factor. What does discounting do? Mathematically, it takes you from future value to present value. What is the opposite of discounting? Compounding. What does compounding do? It takes you from present value to future value. So from the first year, I would say 15.42 is my provision into 10%. That is equal to 1.54. Acha, what will be the journal entry for double entry for 1.54? Do I have to increase the provision or decrease the provision? Acha, if I have to increase the provision, will I debit or credit? Sorry? Credit. Provision as a credit balance. If I have to increase it, I will credit it. So something account debit to provision. This is 1.54. The problem is, what will I debit? Three options. Will I debit the PP? Why no? There's no additional, it is not directly attributable to acquisition of an asset. Achha, then what is it attributable? Second, if not PP, second option, does it go as general expense in the profit and loss account? Or does it go as finance cost in the, why finance cost? Why not just general expense, other expense? Achha, why is that 1.54 happening? In the first year, it is happening due to passage of time, and any expense which arises due to passage of time. I'll again repeat, any expense that arises due to passage of time is taken where? In the finance cost, where the interest is due to passage of time. If there's a zero coupon bond, have you heard about zero coupon bond? You issue it at 60 rupees, it is going to be paid at 100. Technically coupon is zero, but due to passage of time, an item of 60 you are paying at 100. So if theoretically, if I had to dismantle it today only, then will I spend 40 rupees? No, probably I would have spent approximately 15 rupees. I'm taking 40 because 10 years later, maybe labor cost is high, material cost is high, my estimate is okay, 10 years later this is a cost. But if I have to dismantle it today itself, theoretically the very next second, will I have to spend 40? I will have to spend in all likelihood only 15.42. Yes or no? I'll have to spend 15.42. However, because I'm taking 10 years, I'm spending 40. So the gap between 15 and 40 is due to passage of time. And anything which is linked to passage of time is taken as finance cost. Are we clear with this? Ajay, so every year, will my cost be 1.54 only? No, because compounding, which means I would say in the first year my provision was, for example, in my first year my provision was, in year 1 my opening was 15.4, on which interest cost or finance cost or unwinding cost is 1.54. Closing will be approximately 16.94. In the second year, 16.94 into 10%, this is 1.69. And if you have the patience to do it for all the 10 years, at the end of the 10th year, it should come to, does it necessarily have to come to 40? Yes, because you have used that discount factor at 10, you are compounding at the same rate, it has to come back to 40. But the journal entries over the life would be, at year 0, your entry will be PPE account debit to, let us say, provision. But the moment the first entry is done, then from year 1 to year 10, there is no connection with PP. From year 1 to year 10, it will be what? unwinding cost, which is a part of FC, that is finance cost account debit to the provision in each of the years in such a way that the provision will reach up to 40 at the end of the 10th year. Now at the end of the 10th year, let us say your estimates are correct. We will see a case where your estimates differ, but if your estimates are correct, you will end up paying 40. Your entry will be something account debit to bank, 40. You will pay 40 to dismantle, something account debit to bank. What will you debit? Provision. Will your PNL again get impacted? No. Earlier, before Ind AS 16 used to happen, what did we do? For 10 years, we would do nothing. Then suddenly in the 10th year, you will say expense account debit to bank. There was no provision. So suddenly in the 10th year, there would be a big expense. Yeah, but you are paying the expense in the 10th year. It was not created in the 10th year. The obligation to pay created the moment you constructed. There was an unavoidable obligation, and hence the provision was created initially, and slowly you reach up to 40. Is everyone clear? Is everyone clear? Yes. So this is a very important thing because there are two standards involved. Institute loves asking you questions like this where there are multiple standards in a single case. So here the institute can test Ind AS 37 for provision as well as Ind AS 16 for PP in one go. Because it is just a 70 mark descriptive paper and you look at your index, there are 35 topics. So maximum they can ask on an average if everything has to be covered 2 marks per topic, which is impossible. So they will try to club as many things as possible in one question. So the moment you see things where there are multiple overlapping standards in one concept, you will necessarily know that that is a very important concept in general because there are multiple standards in one, let's say, adjustment. Are we clear with this? Okay. Now, so is everyone clear with this? Now a very special case over here would be, and it is one RTP question has come on this, is generally we are always trained to think that site restoration provision is created only and only at the time of construction. But is it necessary that site restoration creates only at the time of construction? For example, let us say, let me take an example of an oil well. Let me continue with the same example. Let us say I have dug up an oil well. And the moment I dig up that oil well, I believe that after 10 years, I will have to dismantle, which will cost me 40 rupees, all else remaining constant. However, I also have a commitment to clean up the seabed. Now, the seabed is currently not dirty. But as I extract oil each year, the seabed becomes dirtier and dirtier. As I extract, let's say, 10 metric tons or whatever unit is there of oil, in 1 year it becomes dirtier. Another 10, in the next year it becomes further dirtier. And then we believe that at the end of 10th year, I will have to incur simplistically another 40 rupees. 140 is to dismantle the oil well. Another 40 is to site restore, to clean that entire surface that I have kind of damaged. Should I create a provision for 40 plus 40, that is 80 at present value terms? Did you understand the example? The example over here is the same example, but in this case, what we were told is, you have constructed an oil well. To dismantle that oil well, you will have to incur 40 rupees after 10 years. But you have two obligations. One is to dismantle the oil well. Second obligation is to restore the seabed in the condition it was prior to the time you took it, which is absolutely clean. When you constructed, the seabed was not damaged. So is there any obligation to dismantle in the current year? At year 0, is there any obligation to clean up? But in the first year, you extract 10% of the total oil. The seabed gets damaged. Now is the obligation born. Another year you extract another 10 metric tons. It gets further damaged. Is the obligation further created? For example, for each year of damage, 4 rupees ka you think there will be cost. 4 rupees each year, approximately 40 rupees at the end of the 10th year. When is the obligation born? Is the obligation born immediately for that 4444 rupees, or is the obligation created each year? Each year. So again, will you have to create a provision? At the end of year 1, let us say you are at the end of year 1, another obligation for 4 rupees gets created because you have extracted oil in the first year. And so if you do no further extraction, still you will have to do some cleanup, and that cleanup will cost you 4 rupees. That 4 rupees will be incurred. Think and tell me after how many years? No, number after 9 years. Life was 10 years. 1 year has gone by. So at the end of the first year, obligation to clean up is created, for example, which is going to be spent after. So when I create a provision into present value factor at the rate of 10% for which year? 9th year. Similarly, when you go to the second year, you extract further oil, another 4 rupees into present value factor at 10% for the 8th year. Acha, will all of this also be unwound in the same manner? Are we clear with this? Acha, when I create this, let us say, I don't know the number exactly, but let us say for simplicity, this is 1.6. For simplicity, whatever the discount factor, I'm assuming it's 0.4. So let's say this comes to 1.6. I will have to create a provision for 1.6. Acha, my entry will be something account debit to provision. Now you have to be a little careful. What will I debit? Will I debit PP? This is something that you have not done as much. There is just one RTP question on this concept. Otherwise, in study mat, there is no such question. Will you debit the PP for this 1.6? Is it directly attributable to construction of the oil well? Or is it attributable to extracting oil? Achha, but oil is inventory for me. So when I do Ind AS 2, it will be capitalized along with my inventory cost. So when I try to find the total cost of the inventory, the cost of oil for me, so if I've extracted 10 metric units of oil, what is the cost of extraction of that oil, blah, 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 plus 1.6. So whatever is the cost of extraction of oil, the labor that was used, the materials that were used, everything, plus 1.6 rupees, that will be added along with the cost of the inventory, because it is directly attributable to extraction of your inventory and not construction of your asset. Are we understanding it? So when I say provision is created, provision is the second effect, Ind AS 37. The first effect will go where the directly attributable item is. So if the obligation was created because I constructed the oil well, the effect will go with PP. But if the obligation was created because I extracted the oil, the second effect will go with inventory. Are we understanding it? In my opinion, PP is more important, but having said that, inventory has come in one of the recent RTP adjustments as well. Are we clear with this? So site restoration provision has to be created at present value basis, later unwound. But the second effect will go to either PP if it is directly linked to construction of the asset, will go to inventory if it is linked to extraction of resources or extraction of your inventory items. Are we clear with this? Any problems here? Okay, so this is regarding site restoration. I would rate this as one of the very important things of this. So there is site restoration, there is subsequent expenditure where you are incurring, let us say you are buying a new part, there is revaluation model, and there is component method of depreciation. Four most important things of Ind AS 16. Site restoration, subsequent expenditure where you buy a new part and remove an old part, revaluation of PP and all of its effects, and lastly component method of depreciation are the four most important things. So this is one of them. Okay, fair enough. Now a few other things like your generally accepted accounting practices tell you that losses, if there's a normal loss, what do you do with normal loss? Do you understand the difference between normal and abnormal loss? Normal loss is a loss which is it happens in the ordinary course. Whatever you do, it will happen. So normal loss, what do you do? Add it to the cost. But abnormal loss, what do you do? Take it to P&L. So if you are constructing, let us say, an asset, and there was a flood which was abnormal in nature, because of which there was some damage. So that damage will be taken to the profit and loss account because it is abnormal in nature. But if you are constructing an asset and you are using some materials, now you know that some materials in the normal course will be probably let's say 2% of the materials will be spoilt, or like there is liquids get evaporated. So over here you believe that 1-2% will be in the normal course. If it takes 1 year, 2% of the material, that is normal. You are expecting it, well, no adjustment. You don't have to take it to P&L. It will be added along with the cost. Are we clear with this? Acha, in your exam, this is generally accepted cost accounting practice. You did it in CA Inter, CA Final, everywhere. Normal loss capitalize, abnormal loss expense. In the exam, you are just given loss. Company suffered a loss of 10 rupees. They don't mention it is normal, they don't mention it is abnormal. What do we assume? You assume to be abnormal. Institute assumes it to be abnormal in general unless they specifically tell you that loss which was expected by the management, unless they tell you those words that this was loss was expected, we assume it is abnormal. For us to assume it to be normal, and this is institute assumption, for you, so if it is just loss given, we generally assume it to be abnormal unless the question tells you that such a loss was expected by the management to happen in the ordinary course. Are we clear with this, everyone? Okay. Next, there are two special cases. Again, this is the last part of the initial recognition section. One is deferred payment and one is barter. Barter is also one of the important areas. What do you understand by barter? Exchange. Now, usually we have been taught that initial recognition happens at cost. We have been taught that initial recognition, let us say, happens at cost. Just a second. If I look at a barter, the problem in case of a barter is I don't really know what the cost would be. Like for example, if I am a company X, there is another company Y, I give up my car and in return I get some land. Now usually when I acquire land, I pay 100 rupees. So I know land account debit to bank 100 rupees. But here I am paying through car. Now the problem is, car has a WDV of 100, car has a fair value of 150. Land which is acquired, for simplicity, let us say also has a fair value of 150. Achha, is it necessary it has to have a fair value of 150? It can have more or less as well. So now when I pass the journal entries in the books of X, debit what comes in, credit what goes out. What is coming in? Sorry? Land is coming in. Okay, so this is land account debit. Credit what goes out. What is going out? Car. Acha, what is going out will always be credited at what value? WDV. Why? Because otherwise, so it will result in a negative balance. If I credit the car by 150, then my ledger will show a negative 50 for car, which is not possible. And hence I will always debit in barter, always the item going out at WDV only, it will be credited. The question is initial recognition of land. See, car is derecognized. We are studying initial recognition. Initial recognition is of land. Land will be initially recognized at what value? Will it be recognized at fair value, and if yes, which fair value? Fair value of land or fair value of car? Acha, let us say this is 160 rupees. Fair value of the land is 160 and fair value of the car is 150. It is different. Then you will record it, think and tell me, at 160 or at 150? 1? Not at 160? Why no? Okay, the logic over here is, okay, that is the rule, but the logic over here is, your initial recognition base is what? Is it cost or is it fair value? Cost. Standard says initial recognition should be at cost, and cost is what? Cost is what you pay. Are you paying 150 worth of assets or are you paying 160 worth of assets? 150. Now the fair, some students argue that, sir, we are acquiring land is worth 160, so be it. If you go to a shop, there is a pair of jeans which is available at 2000 rupees. On a discount offer, you get it at 1000 rupees. What is the cost of your jeans? You are paying 1000. No, sir, fair value is 2000, so be it. You are not paying 2000. You are paying only 1000. In a similar way, you are acquiring a land of 160. Ideally, you should have paid 160, but you are giving up cash, car, whatever it is, you are paying only 150 worth of resources. Initial recognition happens at cost, and hence your initial recognition will be ideally at the fair value of the assets given up. This is where a lot of students make a mistake. Generally, the thought is, okay, if this is land, it should be at the fair value of the land. Achha, that could have been the case if your recognition base was fair value. When you will go further, biological index 41, when you go further, financial instruments, all of these initial recognition happens at fair value. But PP, intangibles, inventories, everywhere initial recognition happens at cost, and cost is what you pay. Cost is not what you receive, cost is what you pay. No, no, sir, we are paying something worth 150, we are getting worth 160, so be it. Let us assume this was not car. Let us assume this was cash. You are paying cash worth 150. Land has an MRP, land does not have MRP, but let's say hypothetically land has a value of 60 rupees. You are paying 150, you have better negotiating skills. You would have recorded land at what value? Irrespective of the fair value of the land. Acha, by the way, instead of cash, you are giving car. Cost is what you are paying for the asset. And you are paying effectively 150. So what does the law say? The law says that in case of a barter, the first preference should be given to the fair value of the assets given up. Unless you can say that the fair value of the asset given up is not available. For example, this is a car which is a very old vintage car. It does not really have a fair value so commonly available, or the fair value is not reliable. As a second preference, then you will go to the land value. So if the fair value of the asset given up is not available or not reliable, then you say, okay, then probably what you are receiving must be equal to what you are paying. As a second preference, you take the fair value of the assets received. That is at 160, but remember this is a second preference. If fair value of assets given up is available and reliable, you will always take that only. And what if this is also not available? WDV. Like in CA Inter, if you remember amalgamation, when you do amalgamation, you take over assets at fair value, but if fair value is not available, you assume book value is equal to the fair value. So ideally, there should be fair value, but as a last resort, if fair value is not available, then you'll have to take WDV. Now, some students unnecessarily go into more detail. They say, sir, fair WDV of which asset? Of asset given up or asset received? According to you, which asset should it be? Why? There is no way in which you can know the WDV of asset received. You can get a broker to come, a valuer to come and tell me what is the fair value of this asset land. But I will never know what is the ledger balance in someone else's books. And hence it is impossible in general to find the WDV of the asset received. So there is no fourth preference. It is only three preferences. First, fair value of the asset given up. If not available, fair value of the asset received. If not available, WDV of the asset given up. Are we clear with this? So, if the fair values were not available, we would have said, okay, land account debit 100 to car 100. Are we clear with this? Acha, here, let us say the fair values were available, in which case the land would be recorded at 150, but there will be a balancing figure of 50. Where is this balancing figure going? PNL or revaluation? PNL, very nice. A lot of students make a mistake over here. They say, okay, this is barter, take it to revaluation. Revaluation is wrong. This is a car of 100. The risk and reward of the car is transferred. And for that, by the way, we are getting land. We would have gotten cash, but we are getting land. But nevertheless, we are no longer having the risk and reward of the car. So 50 is realized gain. By the way, it is not realized in cash, but it is realized in some other non-cash means. But it is realized gain, and hence the law tells you that you should take it as gain on barter in the statement of profit and loss. Do not touch the revaluation reserve over here. Are we clear with this? So over here, when you look at the theory, we will say that in barter, this is what you need to do in case the barter has commercial substance. What do you mean by barter having commercial substance? It's a genuine barter. It's not a barter on paper. What do you mean by barter on paper? Barter on paper means, let us say this was, this is car and land. Are these two different assets? Yes, but let us say so let's say there are two companies. Now they are struggling to kind of have report profit. A talented chartered accountant like you goes and they ask you that how do I manage something? They say that, okay, do you have a car? They say yes. Does Y have a similar car? Yes. So what is the WDV of the car? We say this is 100. What is the fair value of the car? We say is 150. So we tell X that what you do is you on books show that you are transferring this car, and in return take a similar car. You have a Honda City, they also have a Honda City. You have a 2020 Honda City, they also have a 2020 Honda City. Almost similar asset. So let us exchange these similar assets. We'll say what will happen? Array, car is going out, another car technically is coming in. The law says you will recognize the new car at fair value of the asset given up. So your entry will be new car account debit to old car. Acha, old car will be credited at 100. New car will be debited at 150, and hence you will manufacture 50 rupees of profit. If you were to revalue your own car, so it would have gone in the revaluation reserve. If you show it as a barter, it will go to the profit and loss. And hence this would have technically gone to the P&L and you could have manufactured profit. But this is a genuine barter. This is a barter what you call as lacks commercial substance. It is a barter that lacks commercial substance. How will we know that it lacks commercial substance if the company was in the same position pre and post the barter? Acha, earlier I had car, now I have land. Am I in the same position or my position differs? Slightly differs, right? But if earlier I had a car, now also I have a similar car. Will I be in the same position? By and large, in which case I can say that the barter lacks commercial substance, and if the barter lacks commercial substance, you will skip all the rules and you will say you will record the transaction at WDV only. It is like saying in amalgamation, remember you had amalgamation in nature of merger, nature of purchase. Whenever it was merger, we said no, fair value nahi hoga, we will take WDV only. But it was purchase, we said fair value, genuine acquisition. Merger was just same companies merging. In a similar way here, we say barter lacks commercial substance, it is on paper only. And hence, we will not allow you to record this at fair value. In fact, if you're telling me it's a barter, you record it at WDV, but the moment you record it at WDV, the gain automatically will not come. It is new car account debit 100 to old car 100. And as a result, there will be no gain. You have plugged the loophole. Are we clear with this? Now the problem happens, theoretically people understand this, the problem happens in the exam. How will you know that this is a barter having substance or lacking substance? You will see in the exam if there are different assets exchanged. In your study material, there is a sum where you are giving up land and acquiring a private jet. These are two different assets. Does it have substance or lack substance? Have substance. Now the problem is, there might be another question in the study material where they say one warehouse is exchanged and another warehouse is taken. One car is exchanged, another car is taken. Now, does this have substance or lack substance? We don't know actually. You will have to see the facts. For example, I might have a Mercedes car. I don't have it, but let us say I might have a Mercedes car, and I think that what is the use of this Mercedes? It is one car. Uske badle, instead of that, I will barter it for 10 small WagonR cars and maybe put it in an Ola or an Uber operation. So now I am giving up a car against cars. But does my position pre and post barter change? Does it have substance or lack substance? Have substance. I earlier had a warehouse in Mumbai. My factory was located, let us say, near Calcutta. I wanted a warehouse near Calcutta. Someone else wanted a warehouse near Mumbai. We did a barter, but that helped us getting a warehouse near our, let us say, factory, which helped us in saving a lot of transportation cost. Is my position same pre and post the barter? No, is it slightly different? Genuine barter. It is not a barter just on paper. You are actually wanting the warehouse of Calcutta, not just on paper. And hence in such cases, the barter still has substance. So in general, when you see in the exam, if there are different assets, no problem. Different assets always has substance. Similar assets being exchanged, you will have to look at the facts. Question should ideally give you facts that warehouses are in different localities, cars have different features, something they will give you. But if they remain silent, then you can say that it lacks substance. If they tell you car X exchange for car Y and they tell you nothing, then you can assume either of the two. You can assume lacks substance, has substance. Either of the two you can assume. The institute usually but assumes that it has, has substance, unless given otherwise. If it has to lack substance, they will give you data. So it is innocent until proven guilty. Unless the question gives you data to prove that no, there is some misdoing involved, ICAI typically assumes that it has substance. Are we clear with this? So what is the rule in the exam? First, you see, we have just kind of mentioned that over here. First, you see, I think it should be there. If the question is silent, if there are different assets exchange, it has substance. Similar assets exchange lacks substance. But if nature is not determinable only, Well, machine X with machine Y. We don't know what machine X is. Machine X can be AC, machine Y can be a projector. Then you assume that it has substance. Innocent unless proven guilty. Are we clear with this? Is everyone clear? Yes? Okay, so this is about Barter. Again, if you study Barter here properly, we are not studying one standard, we are actually studying three standards. Exact same will apply in intangibles, exact same will also apply in investment property. It is exactly the same. Yes, please. But you will not record. That is not permitted to be recorded under GAAP. So gain on purchase is not to be recorded, it is gain on sale. Your asset that is going out, on that there is a gain. No, not the other way around. So over here, are we clear with this? You do a little more practice and you should be clear. Yes? Okay. That is one, and the last part for initial recognition would be deferred payment. Again, this is applicable throughout your syllabus, not just Ind AS 16, not just Ind AS 38, not just Ind AS 40, also in Ind AS 2, inventory, also in Ind AS 115, revenue recognition, everywhere. Standard has a 12-month barrier. Standard says that normal credit, if you are giving normal credit, if you are a seller, or if you are getting credit, if you are a buyer, normal credit at max 3, 6, 9, 12 months. Beyond that, no one gives you free credit. Acha, do we usually get free credit? Yes. If you have good relationship, something as basic as, let us say, if a milkman comes to your house, let us say the rate per liter of milk is 50 rupees. They say you pay me at the end of each month. If you have consumed 30 liters of milk, you have to pay 15 to 30 only. Na? Does he charge you any interest? No, but is he giving you 1 month time? But that is free credit. Normal business credit is typically free. No one charges you interest during the credit period. But if you tell them that ek kaam kar, instead of 1 month, you come after 2 years, will he still go? First of all, he will not agree, but nevertheless, if he agrees, will that rate still be 50 rupees per liter? No, he will say, no, if you have to pay me after 2 years, I am giving you so much time. You also have to pay me for the time. Now, whether it is explicitly written or explicitly not written, the standard assumes that the moment the time gap goes at or beyond 12 months, there has to be a hidden interest. No, it is not written. We have agreed to buy, let us say, for example, you are buying an air conditioner from Chroma. Chroma says that if you buy the air conditioner today, it costs you 20,000, or we can give you a credit of 2 years. Then you have to pay me 24,000. On the invoice, you say I don't have money now, I will clear in less than 2 years. But let us say I will pay you after 2 years. On your invoice, it is only 24,000 printed. As an article, you do verification and vouching. In verification and vouching, you look at the voucher. Voucher pe to 24,000 is written. Generally, your entry is PP account debit, to payable 24,000. Is that correct? No, the PP is worth 20,000 only. No, you are paying 24,000, you are paying 4. That extra 4, are you paying for the AC? No, you are not getting a better AC, you are not getting a better brand, you are not getting better star rating. You are paying 4,000 extra because you are getting time. And if you are paying 4,000 extra for time, that cannot be capitalized into the asset. Asset is ready for use. Your AC is ready for use. You are paying for the AC after 2 years. So be it. AC aa gaya, you have installed the AC, it is ready for use. And as a result, we will say, no. We will have to modify the treatment. Your entry will be PP account debit 20,000. Cash price equivalent. Otherwise, you can find the present value of 24,000. You will say 24 after 2 years is equal to how much today? Let us say 20,000. PP account debit 20,000 to payable 20,000. Understanding? So, after that, over the course of 2 years, approximately, you will recognize 2,000 of interest, 2 and 2, 4,000. So what will be your entry? Are you understanding? Initially at year 0, you pass the entry PP account debit. We said no. We cannot record the PP at entire 24,000 because out of the 24, 4,000 is linked to passage of time. You are paying 4 because you are getting time, not because you are getting a better asset. And as a result, PP account debit to payable will be, let us say, 20,000. Now, in year 1, time has passed. 1 year has passed. So, something has to be done. So, in year 1, you will say something account debit to payable, approximately will increase the payable by 2000. But what will you debit? Will you debit the PP? Why no? Because it is not a qualifying asset. Asset is ready for use. And this is expenditure after it is ready for use. Acha, but this is expenditure due to what? Passage of time, and hence this will also go in finance cost, and finance cost will go to the profit and loss. Second year also approximately the same entry, finance cost account debit to payable at 2000, and then at the end of the second year payable account debit to bank. Are we clear with this? So payable will be debited by 24. Payable was 20 plus 2 plus 2, so 24, and to bank. In the older standards, this clause was not there, which means you would have said 24's asset, recorded 24. Ind AS says no. If the gap that you are getting is at or beyond 12 months, there is hidden interest inside. And you will have to remove the hidden interest and record the asset at either the cash price equivalent, and if not available, then the present value of the payments. Are we clear with this? So these are the two special cases if it comes on the section of initial cost. Are we clear? Acha, we'll try a couple of questions on this and then kind of go further. So on your volume 1, if we do a few questions pertaining to this section on PP. So we will go to question number 1, mark it as important. It's a good question. Question number 1, we should be on page 81. Let us quickly discuss this. Two small areas where assumptions are possible. An institute in one of the exam question, I think May 23 question is similar to this. They have used the data over here for the May 23 question as well. X Limited started construction of a building for its own use on 1st April 2010. The following costs are incurred. Purchase price of land, should that be capitalized? Stamp duty and legal fee, should that also be capitalized? Architect fee, directly attributable. Site preparation, materials, direct labor, general overheads. No, why? General, not directly attributable, general. Others were directly attributable and hence you can capitalize. Okay, other relevant information. Material costing 1 lakh had been spoilt and therefore wasted, and a further 1 lakh 50 was spent on account of faulty design work. So we don't know what that 1 lakh 50 is. That 1 lakh 50 can be further material cost, further some cost was spent due to faulty design work. As a result of these problems, work on the building was stopped for 2 weeks during November 2010, and it is estimated that 22,000 of labor cost relate to that period. The building was completed on 1st January 11. When did it start? 1st April 10. When did it complete? 1st January 11. So approximately it took how many months? Difficult question. It took how many months? 9 months. Acha, is that a substantial period of time? No, it is not a substantial period of time. And as a result, if the question remains silent, is it a qualifying asset or no? But 12 months is not a necessary rule. If the question tells you that the company believes it is a qualifying asset, can you still treat it as qualifying? Yes. So in the exam, if the question was silent, you will not treat it as a qualifying asset. But if the question tells you, then you will solve accordingly. And brought into use from 1st April 11. Achha, just for my knowledge, my depreciation starts when? Does it start from 1st January or 1st April? First? Perfect. You start depreciating the moment the asset is ready for use and not necessarily when it is put to use. So 1st January is the relevant date. X Limited had taken a loan of 40 lakhs on 1st April 2010 for construction of the building, okay, which meets the definition of qualifying asset as per Ind AS 23. We have specifically been told that it meets the definition of qualifying asset as per Ind AS 23. So will you consider the borrowing cost for this? Yes. The loan carried an interest at the rate of 8% per annum and is repayable on 1st April 2012. So that is 1 or 2 years. Calculate the cost of building that will be included in tangible non-current asset as an addition. So broadly all of these should be included. There is no ambiguity over here. There are 2 or 3 adjustments that you have to guide me with. You have to answer, okay? First is 1 lakh of materials that was spoiled, and assume another 1 lakh 50 of material or some other cost. So total of 2 lakh 50 incurred due to some faulty design as well as spoilage. What do you do as a concept? Should that 2 lakh 50 be a part of cost, or should it not be a part of cost? Why not? Abnormal loss. If it is already a part of cost, you will deduct. If it was not a part of cost, you would have ignored. Acha, what do you guys think? Is that 1 lakh and 1 lakh 50 already included somewhere? Yes. Materials costing 1 lakh has been spoiled. So probably out of that 10 lakh material, 1 lakh would include the materials that was spoiled. Should that be a part of cost? You will deduct it. And further 1 lakh 50 on faulty design work. That 1 lakh 50 can be assumed to be included somewhere. If you assume it is not included somewhere, then you don't deduct it. Institute in May 23 paper, a similar adjustment had come. They have given you printed in suggested answer 2 alternative solutions. If you assume faulty design work is already included in some of these cost headings, then you deduct. If you assume 1 lakh 50 is not included, then you don't deduct. Are we getting this? In the exam, what should we do? This is study material question. We will assume, unless otherwise given, that 1 lakh 50 must be included somewhere. Maybe material, maybe architect fee, may be included somewhere. And hence we are deducting. The alternative solution is possible and also given in the May 23 suggested answer. Are we clear with this? So over here, you will have this total cost. How much is that? 34, 34.5, 40. Is it 48.5? Let's say 48.5 total cost. From this 48.5, will I subtract 1 for materials and 1.5 for faulty design? Why do I subtract it? Abnormal loss. But remember, you have to read the language. If the question had told you that in addition to the above costs, material worth 1 lakh was spoiled. If those 4-5 words were given, will your solution change? Yes. As a concept, abnormal loss should not be included. Well, by the way, it was not there. If the question had told you in addition to the above costs, material cost of 1 lakh was incurred for material spoiled, then we will say, okay, that means a material of 10 lakh does not include 1 lakh. Should not include 1 lakh, no adjustment needed. But here, nothing is mentioned. So we will say that that material includes all materials. And as a result, we deduct it. Are you understanding it? There are no two, concept is same, abnormal loss should not be there, but here it is there, so we are removing. If it was never there, we would not have removed. Is everyone clear? Yes? Okay. So over here, what about this 22,000 of labor cost? This is work was stopped for 2 weeks, and during those 2 weeks, labor was sitting idle, and hence you had to pay 22,000. Is that directly attributable to construction? No. Is that also an abnormal loss due to the spoilage and faulty design? Should you also deduct that? Probably this entire 4 lakh of labor includes the 22,000. Should you deduct the 22,000? Is everyone clear? Okay, and now comes the last part, which is loan. You have taken a loan and the question tells you that the asset meets the definition of qualifying asset, which means the borrowing cost should be capitalized or not? Capitalized. Such a how much borrowing cost? 40 lakh of loan into 8%. For how many months? But why not the last 3 months? The asset is ready for use. The moment it is ready for use, capitalization stops. Any further interest will go to the profit and loss account, and hence into 9 by 12. So 40 lakhs into this comes to what? 2 lakh 40, and hence you will also capitalize this 2 lakh 40. So if I go to see over here, we are subtracting. The important adjustments are these. If you want to mark when you are revising, you just have to revise this. What is happening to the spoilage, faulty design, idle labor, and borrowing cost. So these are the things, and 2 lakh 40 for the borrowing cost. Are we clear with this? Acha, if you open the study material, the recent study material of May 24, Institute has removed this line. They have removed this bracket wala sentence. Do you think their solution will be different? Yes. What will be the difference? 2 lakh 40 will not be capitalized. Perfect. Here we have included it because We have clearly been told in the question in the earlier materials they had included. So we have still kept the same thing so that you are able to contrast both. So if that sentence is not there, then 2 lakh 40 will go to the PNL. Because this sentence is there here, we are capitalizing 2 lakh 40. Are we absolutely clear with all the small nuances here? Acha, I'll make one more discussion here. Rightly so. Some students, any other doubt here? Some student might argue that for this 2 weeks, that work was interrupted, labor cost was incurred. Did we capitalize the labor cost? No. But in those 2 weeks, interest cost would also be incurred. 2 weeks, approximately half a month. So some student might argue that ideally the capitalization should not be for 9 months. It should be for 8.5 months, because that half month also you are paying interest, but work is not happening. What do you think? We have not studied it now in today's session, but if you have done Index 23, borrowing cost, what do you think if work gets interrupted for some period? Do you suspend capitalization or you continue capitalizing? But what are the conditions of suspension? Extended, very nice. Suspension of capitalization should be done only if interruption is for an extended period of time. Now what is extended, we don't know. Like why is that extended period given? Like for example, in India sometimes suddenly there is Bharat Bandh. So someone says, okay, no, there is strike entire Bharat Bandh. So work is not happening for 1 day. But it's a 3-year project. If 1 day work is not happening, it is not very material. So to find out for 1 day how much is interest, don't capitalize it interest, they say no. If the work was suspended for an extended period, usually it gets suspended for extended period when you are in a lawsuit. If someone puts a lawsuit on you, there's a stay order, khatam. Then for next 1, 2, 3, 4 years, your project is stalled. So that is an extended period of interruption. Now, as a student, how will we know it is extended? Thumb rule. It is not written in the standard anywhere. Thumb rule is 10% of project life. So if your project life is approximately 9 months, that's 270 days. 10% of that, 27 days or approximately 1 month. If interruption was beyond that, we would have said this is extended period of interruption. Material. So, but extended has not been defined. So, how will we know as a student is extended or not? So, generally in your mind, you keep 10% as a barrier. So, if your interruption goes on for beyond 10% of the project life, we say it's a fairly big interruption. 10% of the life se upar ja raha hai. It's going more than that. And as a result, we will say we will stop capitalizing for that period. Here, what do you think? Is 2 weeks? That is half a month approximately. Is that an extended period of interruption? Yes or no? Out of the 9 months of project life, that is approximately 250 to 70 days. 2 weeks is hardly 14 days. It does not appear to be an extended period. Having said that, because extended period is not defined, if you tell the examiner that we are capitalizing for 8.5 months, assuming half a month is extended, he will give you credit, 100%. But that is a note that you have to write. Or if you don't include and say that we are continuing capitalizing because we are assuming 2 weeks is not extended period, you will still get credit. Are you understanding it? Preferably mention. So over here it is preferable that you give that assumption. And again, it's always advisable. If you see the first thing of your question paper, they say write working notes part of answer, give notes and wherever required. So why should you wait for that? So you give a note, that's absolutely fine. So when you see your printed notes now, you will see 2-3 things. There'll be notes and then there'll be reference notes. Notes are something that you are expected to write in the exam. We have assumed that the losses are abnormal. Interruption of 2 weeks is not an extended interruption. You can write it in your own words, but we expect that you write this. Reference note is a note for your understanding. You don't have to teach the examiner. Right, that if this was happening, you should do this, and this was happening, you should not do this. This is for your reference. So when you are revising, reference note is for your understanding. Just a note written is something that you are expected to also mention in your exams. Are we clear with this? Okay. So your asset would be capitalized at 48 lakh 18,000. In this particular case, you have studied abnormal loss adjustments over here. You have studied the borrowing cost capitalization adjustments over here. Is everyone clear? Any problems here? Okay. Next, you go to question number 2. It's an RTP question. This is largely pertaining to site restoration. On 1st of October 17, A Limited completed the construction of power generating facility. The total construction cost was 2 crores. What do you guys think? Will the 2 crores be capitalized? Yes. The facility was capable of being used from 1st October 17, but A did not bring the facility to use until 1st January 18. When will depreciation start? 1st October. The estimated useful life of the factory on 1st October was 40 years. Under the legal regulations in which the jurisdiction in which A operates, there is no requirement to restore the land on which the power generating facilities stand to its original state at the end of the useful life of the facility. Think and tell me, do we have a site restoration obligation or no obligation? No obligation. However, A has a reputation for conducting its business in an environmentally friendly way and has previously chosen to restore similar land even in absence of such legal requirements. In Ind AS, do you also create a provision for constructive obligations? Yes. So will we create a provision? The directors estimated that the cost of restoring the land in 40 years' time, based on prices prevailing then, would be 1 crore. A relevant annual discounting rate used in any discounting calculations is 5%. When the annual rate is 5%, the present value of 1 rupee receivable is 0.142. So you have been given the discount factor. Analyze and present how the above events will be reported in the financial statements of A Limited for the year ended 31st March 18 as per Ind AS. Now this is interesting. What are they asking you? Analyze and show how they will be reported in the financial statement. So preferably in such cases you can show an extract. You don't need to prepare schedule 3 format, but you can show an extract on how they will be appearing. So what all will appear in the balance sheet, let us say? Will PPE appear? At what value will PPE appear? Only 2 crores? 2 crores plus 1 crore, that is 3 crore? No. 1 crore is based on prices 40 years later. So you will have to find the present value. Are you given the present value factor? 0.142, that is approximately 14 lakh 20. So what is the initial cost of the PPE? 2 crore 14 lakh 20,000. That is for PP. On which date is this cost? 1st October. The question is asking you to show when? 31st March. So will my balance sheet show a PP of 2 crore 14 lakh 20 on 31st March? Will there be depreciation? For how many months? 6 months. So we will say that your PP will be 2 crore 14 lakh 20 and then there will be depreciation. 2 crore 14 divided by 40 into 6 by 12. Here you have to apply that understanding that depreciation starts the moment it is ready for use, irrespective of when it is put to use, and you will get depreciation and this will be shown as PP. Are we clear with this? Acha, but is that it? Are we seeing anything else in our financial statements? Provision for site restoration. Acha, where does provision for site restoration appear? Non-current liabilities under provisions heading. So when you look at the schedule 3 balance sheet, you will have equity, non-current liabilities, within that financial liabilities and so on, and current liabilities, financial liabilities and so on. Here there is a provision for site restoration. Where is this going to appear? Non-current liabilities. Remember, this is very important because the moment you get generic questions like this that show how will they appear in financial statements, you have to see that if something is current, something is non-current. Here is anything current? No. The entire 2 crore 14 lakh 20 is non-current. But the 2 crore 14 lakh 20 is on which date? 1st October. Will there be any change on that? 2 crore 14 lakh 20 into what? Into 5%. Acha, but for how many months? 6 months. So this will come to approximately 35,500. But what will you do with the 35,500? Will you deduct it from 1420 or add it? Add it as finance cost. So this will be 14 lakh 55,500. Are we clear with this? This will be your closing balance of the provision within the heading of non-current liabilities. Provision for site restoration will appear at 14,55,500. In the exam, you have to be very careful about this date. Sometimes this might be 31st March 19, in which case a further 1 year of depreciation and a further 1 year of unwinding will come. Usually we kind of skip through that and we kind of quickly do the working and proceed. Be very careful where institute is asking you. Are we clear with this? 14 lakh? No, sorry. Unwinding will be based on 14 lakh 20 into, oh, sorry. So this is 14 lakh 20 into 5% into 6 by 12, that is 35,500. Are we clear with this? Yes? Okay. In your PNL will something appear? What will appear? But do I have to prepare extract of PNL also? Why? The question has told me how it will appear in financial statements. Now technically one can also say that cash flow etc. Institute does not do into all of that. They do balance sheet PNL. Sometimes they will only ask you calculate the carrying value to be shown. Carrying value means balance sheet only. But if they say financial statements, broader term, balance sheet as well as profit and loss account. So these are small things where you might not even know, and unfortunately your marks get deducted because you must have shown the closing balance in balance sheet and proceeded. Institute expects you to even show your P&L statement. Are we clear with this? So what goes in P&L over here? Depreciation, under which heading? Depreciation and amortization. And second, what goes? Finance cost, under which heading? Unwinding cost, under the larger heading of finance cost. Are we clear with this? So this will be within the section of expenses, depreciation and unwinding of discount, which will be as a part of finance cost. Are we clear with this? Non-financial liability. Yes. Are we clear with this? Yes? Okay. So over here, you will, are we clear with this? Any problems here? Okay. There was one particular thing which we did not discuss earlier, that is in site restoration, one of Institute's favorite things. Is there a possibility that there is a change in the estimate of site restoration? What we assumed in our example, just a second, I'll put my pencil on charging for a minute. What we assumed in our example is we expected 40 rupees to be spent. Year 1, year 2, year 3, year 4, year 5, every year we expect 40 only will be spent. But is that necessary? No. Is it possible that our estimate changes? Let us say after 4 years our estimate changes. We earlier thought that we will have to incur 40 rupees and hence we were doing some working. At the end of the 4th year, we now believe that no, just a second, we now believe that no, it will not be 40, it will be 50. Where will the second effect go according to you? Or how will you quantify it? Let me just work around your provision year 1, 2, 3, 4. Help me with the calculations quickly. Let's say this is 15.4. Your finance cost in the first year would be 1.54. Closing would come to 16.94. 16.94, 1.69 comes to 18.63. Then 1.86 comes to 20.49. 20.49 and let's say around 2.05. Closing comes to, and so on. We are slowly going towards 40 rupees. Now let us say at the end of the 4th year, if I want to back calculate this 22.54, is there another way to back calculate it? What is that? 40 that I am expecting, but that is after how many years? 4 years have gone by. I am going to spend it after 10 years. So there is still how many years remaining? So another way to reach that to that same 22.54 is to say that, well, at the balance sheet date, I am expecting to spend 40 rupees after 6 more years. So present value factor at the rate of 10% for the 6th year. If I calculate, it should be approximately what? 0.56 44. So if I do 40 into 0.5644, approximately, you see 22.57 or something, which is approximately the same. Are we getting this? So this is how you would have arrived at. Now, one of the principles in Ind AS 37 is when you create a provision, you have to see that provision is created on best estimate. So each year your best estimate was we are going to spend 40 rupees only. But now at the end of the fourth year, you now believe that this will not be at 40. You believe that it will take 50 rupees to dismantle. Labor laws are becoming stricter. It will cost you more to dismantle. Now 50 into 0.5644 should come to 28 point. But is your closing provision coming at 28.22? No, it is coming at 22.54. So can I continue showing it at 22.54? I'll have to restate it at 28.22. So am I increasing the provision or decreasing the provision? Which means credit or debit? Credit. Now I am increasing the provision. I can also be decreasing it. Maybe it becomes cheaper to dismantle. Maybe now you can dismantle using explosion technique. You can just explode it and end of story. So it becomes a lot more cheaper. So over here, this is provision credited. By how much will you credit the provision? 28.22 minus 54. How much is that? Any other way in which you can find this 5.6 approximately? Any other way? This is one of the ways. 10 rupees. You will say forget 40, forget 50. My entire working is done. I believe 10 will be spent more. But that 10 will be spent more after how many years? 6 years. So 10 into 0.5644 will approximately come to that same 5.6 number. So either ways you solve, it's fine. Now the problem is, where will the second effect go? Will it be adjusted against the P&L as finance cost? Is this additional 5.6 due to passage of time? No, you are still going to spend after 6 years only. It is not due to passage of time. It is due to the cost itself increasing. So can I debit finance cost? Perfect. I can't debit finance cost. Can I just debit a general loss in the P&L? Why no? It is related to asset. Perfect. This makes your asset more cheaper or more expensive as a case. Maybe earlier when you bought the asset, you thought I have to pay only 90 plus 15.4 or something. Because you thought that, okay, when you bought the asset, you thought I'll have to pay 90 today and 40 after 10 years. But do I have to pay that? No, I have to pay, I already paid 90, but I'll have to pay 50 after X number of years. And hence this increases the cost of my asset. So the second effect will go where? PP. The second effect will be taken against the property, plant and equipment. This will go either ways. Whether there is an increase or whether there is a decrease. It can, some can also come where your estimate goes from 40 to 30. In which case there will be a decrease in provision. Provision debited, credit goes to PP. PP will be credited. It is like saying that, let us say you had purchased an asset and for 100 rupees with GST of 18 rupees. Later date, the supplier says that the GST is 28 and he recovers it from you. That additional 10 is the cost for you for the asset only, no? And as a result, this will increase the cost of the asset, and hence this 5.68 will be adjusted against the cost of the asset, will result in depreciation effects being changed. Are we clear with this? Now one more, so is everyone clear? So long story short, whenever there is a change in the estimate for site restoration, in the year when there is a change in the estimate, you will try to find the present value of that change and adjust it against the PP. Provision with the second effect going to PP. A question might arise that why not adjust 15.54 only? Ideally this 15.4 was calculated as 40 into 0.385. Ideally this itself should be 50 into 0.385. Why not? End of fourth year, so what? Why not retrospective? You can do retrospective change. Why not retrospective? That is right. It's a change in accounting estimate. Law says that errors can be retrospectively restated. Accounting policy changes can be retrospectively restated. However, changes in estimate should be given effect to prospectively. And that is why whatever has happened in the past, it has happened. It was not an error. It was an estimate, and estimates are bound to change. So over here, what has happened in the past has happened. For the first 4 years, you will not touch anything. The moment the estimate changes, prospectively you will change, because it is a change in accounting estimate. Are we clear with this, everyone? Okay. Now, based on that, you have this question number 3. An entity has a nuclear power plant and a related decommissioning liability. The nuclear power plant started on 1st April 17, and the plant has a useful life of 40 years. The initial cost was 1,20,000, which included an amount of decommissioning cost of 10,000. Acha, should my initial cost ideally include site restoration? So is it correctly included? Yes. Which is represented by 70,400 in estimated cash flows payable in 40 years. Discounted at a risk adjusted rate of 5%. So what is happening? You estimate on 1st April 17 that I will dismantle after 40 years and it will cost me 70,400. You try to find the present value, it comes to 10,000. And you include that 10,000 in the PP. Is that correctly done? Exactly how it should be. The entity's financial year ends on 31st March. Now on 31st March 27, that is, we are how many years down the line? 10 years. The present value, question clearly tells you the present value of the decommissioning liability has decreased by 8,000. Present value has decreased by 8,000 and the discount rate has not yet changed. How will the entity account for the above changes in the decommissioning liability if it has adopted the cost model? Acha, first of all, after 10 years, there is a change in the estimate. Should you consider that or ignore it? Retrospective or prospective? Which means the effect will come in March 27 only. Acha, is the provision increasing or decreasing? Increasing or decreasing? Provision decreased by 8,000. Decreased by 8,000 means debit the provision, credit? Provision debit. Now, will you debit by 8,000 or 8,000 into present value factor at the rate of 5% for 30 years? 8,000. However, if this word was not printed, had they told you that on March 27, the decommissioning liability, which is estimated to be spent after 30 years, decreased by 8,000. Then you'll say, no, 8,000 is reduction after 30 years. Present value, sit and calculate. But here, do we need to do any of that? No, present, it is clearly given that present value. So, provision debit by 8,000. What will you credit? PP. Credit by how much? 8,000. Now, the question ends over here. But if we want to understand the future course, what will happen in the year 27-28? After you pass this entry on 31st March 27, what will happen in the year 27-28? Now, ideally, your depreciation would be what? Ideally, you would have 1,20,000. And 1,20,000 would be divided by how many? 40 years. So, per annum, your depreciation would be what? 3,000. How many years have gone by? So your total depreciation must have been, so your carrying value must be 90. Achha, will that 90 remain the same? Increase or decrease? Decrease by what? So now your revised WDV is 82. Now this 82 will be depreciated prospectively over the remaining 30 years. 82,000 divided by 30. You will be left with 2,733 per annum. Achha. While you are revising, you might also see things like this, which is written as extra. Extra is not what was asked in the question, but for a logical understanding, we do something additionally. Again, do we need to do extra things in the exam? Not at all. So over here, this is additionally, acha, if the question had asked you, comment on the position of the year 27-28, then we would have said, okay, the depreciation would be 2,733. But will there be any further change? Acha. Provision for site restoration. It was earlier 10,000. You must have done some unwinding over 10 years. Maybe you have reached a particular balance. We have come to that balance, let's say of 16,289. You can prepare amortization table or you can do compounding for 10 years. You come to around 16,000. Now will that provision change? Will that provision change? Yes, your provision is going to be debited by 8,000. So it will reduce. And hence what is your revised provision? 8289. So in the year 2728, your unwinding will be applicable on only 8289. 8289 into 5% and you will get your answer. Are we getting this? All of these changes I want to highlight are prospective changes. You have not touched the first 10 years. Whatever happens, happens from the 11th year onwards, prospective effect, because this was a change in accounting estimate. Is everyone clear? Any problems here? Okay. Next you go to a barter case. Question number 4. Pluto owns land and building which are carried in the balance sheet at an aggregate amount of 10 million. Achha, carried in the balance sheet, which means 10 million is what? WDV. The fair value of such an asset is 15 million. It exchanges land and building for a private jet which has a fair value of 18 million and pays additional 3 million in cash. Show the necessary treatment as per Index 16. So is it a barter case? Achha, what do we do in barter? I personally prefer to solve barter over 4 steps. Step number 1, you prepare the chart. Clearly figure out what is going, what is coming, where is cash, clearly figure out. Write down everything in a chart. So over here, if I have to do this, I am Pluto, so I will prepare this chart, put it in a box, so I have to do accounting for Pluto. Pluto owns land and building which are carried in its balance sheet at 10 million. It exchanges the land for a private jet. So it is giving up land, right? So that has to be the first thing. And in return it is receiving what? Private jet. Okay. It exchanges land and building for private jet which has a fair value of 18 million. So jet has a fair value of 18 million. At the top you would have seen land has a WDV of what? 10. Fair value of what? 15. And pays cash of 3 million. Okay, so the cash will come in point 1 or in point 2 of our chart. Point 2, because I am paying cash. In some questions you will see that I might be receiving cash. So cash will go at the top. So you have to be careful about that. How much is cash? 3 million. So first thing is you prepare the chart, and before you start doing anything, ask yourself whether the barter has a substance or lacks substance. Question is silent. Why? Different assets. Very clearly the company is going to be in a different position pre and post the barter, and hence it clearly has substance. Okay, so that is the first thing. Now before you write any, so this is the first part. You prepare a chart. Second, before you write any amounts, debit what comes in, credit what goes out. Get the entry out of the way. Debit what comes in, credit what goes out. What is coming in? Jet. Leave a line. What is going out? Land and cash. This is your step 2 without amounts. Step 3, you will write down what is going out is always at WDV. No exception to this rule. Has substance, lacks substance, does not matter. What is going out is always WDV. What is logic? Array, if you don't credit WDV and you credit land by 15 million, there is a negative balance in land. That will not be possible. So you will credit the land at WDV. This is how much? 10. And this is how much? And now you start thinking, because if you start thinking before this, that given up, received ke chakkar mein, I have seen so many students when I see copies, credit land by 15. Because they say, we have to record it, whatever is given up, karte, you ensure land is credited at 15. You should not do that. So ensure that you keep everything. Now that everything is done, the place where you apply the guidance is for land. Now, for jet, you will say, okay, this is missing. So this is to be recorded at what? Tell me the number. Okay, but that is convenient. There are two 18s over here. One is 15 plus 3. Or there is 18 direct. Perfect. by the way, this could have been 19 as well. Acha, if this was given to me as 19 of jet, will my solution still remain the same? Because jet may have a fair value of 19, jet may have a fair value of 20. I am paying 15 worth of land and 3 worth of cash. I am paying 18 for the jet, and as a result I will take that only. Are we clear with this? So over here this is going to be let us say 18, and this 18 is calculated as 15 plus 3. Are we clear with this, everyone? Yes, okay. So this is 18 calculated as 15 plus 3. But what if this data was not given? Let us say you were not given the fair value of land, or you were told that land is located in very remote area. No transactions have happened in the past. Fair value of land is not reliable. Then what will you do? Then fair value of asset received. Then you would have taken 18, 19, whatever it is. Are we clear with this, everyone? Yes, okay. So this still you have paid 18, no? Maybe there's a bidding war, and in bidding war people pay through the roof, right? Mitchell Stark got 25 crores. So if you end up in a bidding war, people can pay, his fair value might be whatever, he is getting fair, cost for the franchise is 25 crores, right? So over here, when you, even if the fair value of the jet was 17 crores, if you are paying something 18, the cost for you is 18. The law nowhere tells you cost or fair value, whichever is lower. Law tells you initial recognition at cost. Cost is what you pay. Are we clear with this? Yes, please. No, still, but it's the entire transaction's fair value has to be available. Assets given up. Otherwise, you will assume that it is only 3, which is wrong. So the entire set has to be determinable. Okay. So over here, this is pertaining to question number 4. Next, you go to question number 5. This is on deferred payment. Yes, please. No, it is already added. No, when I do 15, if this data is not available, still, no, it is still 19. I am paying land and cash together for getting just one thing, and that one thing is worth 19. So the total payment is for 19, no? So balance will be gain on barter. So if I silence, please. So the balance of, let's say 18, I think 5 will be gain on barter, and this gain on barter will be taken to the profit and loss account. Yes, please. Yes, so the balancing figure will be gain on barter to be taken to the profit and loss. The logic over here is land of 10 was given up for 15. Risk and reward of the land is transferred. So there is a gain. By the way, instead of getting cash, you got a jet. But the risk and reward of the land is transferred. So gain has to be recognized. Is everyone clear? Yes. Because it is cost. Initial recognition should happen at cost, and cost is what you pay. Because if nothing is available, then what will you do? You will assume that what you are paying must be equal to what the value of what you are receiving. No, WDV and fair value mein to fair value is always more superior, no? WDV to must be any old outdated number. Fair value is always more superior. Are we clear with this? Yes? Okay. Okay, we'll go to question number 5. I can see you are looking at watches, right? Okay, so that is a subtle message. I'll just probably, we'll stop for, we'll do 10-15 minutes and then stop for a tea break. Yes, this initial recognition section is done. We were expecting, what have we been told? 1:30, right? Yes, okay. 2 o'clock. Achha, kya baat hai? So this is question 5. On 1st April 11, an item of property is offered for sale at 10 million, with payment terms being 3 equal installments of 33.33 lakhs. Approximately that comes up to 1 crore over a period of 3 installments. Over a 2-year period, Okay, this is where it should click. The moment you see this payment going over 12 months, whether it is an intangible question, investment property question, inventory question, PP question, revenue question, anywhere you see the payment terms going at or beyond 12 months, there is definitely hidden interest. Even in revenue questions, even in inventory questions, even in intangible questions. So same clause everywhere. In revenue, there is some more guidance. That's it. So over here, payments, the exam question has come. This same question has come in the exam, but the other way around. That is in the books of seller. This is a question in the books of the buyer. In the exam, they ask you the same question, that what will happen if the seller had to account for this transaction. If you know for buyer, hopefully, you should know what the seller should also do. So an item of property is offered for sale at 10 million with payment terms being 3 installments over 2 years. Payments are made on 1st April 11, 31st March 12 and 31st March 13. Okay, so at least one installment is going at or beyond 12 months. Here two of them are. The property developer is offering a discount of 5% if the payment is made in full at the time of sale. You need to ignore that, because someone can say it is cash discount and hence should be taken to P&L. No, no, no. Cash discount happens in normal credit period. If you are offering 2-year credit, there is a loan and interest. There is no this discount, that is, it's a loan with interest. If you pay immediately, you don't pay interest. If you pay after 2 years, you pay the loan with the interest. So don't bring the cash discount or anything into the picture. You bring it into the picture in only those questions where payment is within the normal credit terms, within 12 months. Then you can say, okay, this is 1-2% discount. Here, so it is like saying in that Chroma example, if you remember, Chroma is saying the AC is worth 24,000, but if you pay immediately, it's a 4,000 cash discount. Galat. It's wrong. AC is worth 20 only. If you take 2 years to pay, we will charge you 4,000 interest. If you don't take 2 years to pay, we will not charge you any interest. But AC is worth 20,000 only. AC is not worth 24,000. Are we understanding it? Cash discount, the word cash discount will only come if you are within normal credit. The moment you go beyond normal credit, no cash discount concept. Are we clear with this? Okay. So is this beyond normal credit? Okay. Implicit interest rate is 5.36%. Show how the property will be recorded as per Ind AS 16. Now, will the property be recorded at 10 million? Will it be recorded at 10 million? No, 10 million you might pay. That is 33.33, 33.33, 33.33. That is 10 million, 1 crores. But to pay that, you are taking 2 years. Which means the true value of the property is not necessarily 10 million. How will you find the true value? Present value. So you can say that payments, the first payment is happening down payment immediately. Year 0, 33.33. Achha, the next payment is happening 31st March 12, that is after 1 year. Again 33.33. The next payment is happening 33.33. Are you understanding this? Achha, are you given the implicit interest rate or discount factor? Discount factor at the rate of 5.36%. Remember, immediately if you are getting something, the discount factor is 1. 33.33 on today's date is worth 33.33 only. And then you will take the discount factor. Let us say, how much is that? 1.0536, 0.9491 and 0.9008. And if you do some multiplications, this should approximately come to 95 lakhs. Approximately. 33.33 into 1 plus 33.33 into 0.9491 plus 33.33 into 0.9008, approximately 95. Which is nothing but 10 million minus a 5% discount. So ideally the PPE should be worth how much? 95 lakhs. Now is it necessary that you make the payment immediately? No. If you make the payment after over 2 years, your entry will be PP account debit. How much? 95 or 100 lakhs? PP account debit 95. To to bank. Down payment, you are making a down payment of 33.33 to payable. The remaining, I think 61.67 will be shown as your payable to the developer. PP account debit to bank to developer. Then later what will happen, you will prepare a developer account. On 61.67 you will charge 1 year of interest. So this is 61.67 into 5.36%, 1 year of interest, that is 3.31. Then you get the closing balance. Make a second installment payment. Next you go to the next year, again charge interest, make payment and installment cleared. Ultimately balance will come down to 0. We have shown the workings here. But is it possible you make an upfront payment? This is one option if I were to make the payment over installments. But let us say I don't need to make installment payment, I'll make upfront payment of 95 lakhs. Something account debit to bank 95. PP will be debited at what? 95 or 100? Still 95. It is like saying in the chroma example, whether you buy the AC immediately or you buy it over 2 years, you are going to record AC at 20,000 only. No, if you buy it over 2 years, then another 4,000 will be interest. If you buy it immediately, there will be no interest. So don't go into that tangent. A very, very common mistake students make is, acha, if we make immediate payment, then PP will be 100. Why 100? Oh no, we are getting cash discount. There is nothing called as cash discount the moment you go at beyond 12 months. No question is giving. Substance over legal form. Legal form, they might write anything. Chroma might say it's a 24,000 AC with a 4,000 discount on immediate payment. If it's over 2 years, nothing called as discount. It is interest and loan only. That is what the standard says. If it was within the 1 year window, then there is no loan, no interest, unless a question is specifically explicit about it, then it is discount or no discount. So don't go into that thing. PP will be worth 95 only, whether you make payment immediately or whether you make payment over the 2 installments. So by the way, if you make payments over 2 installments, then over and above 95, you will also pay 5 rupees of interest. If you make payment immediately, then you will not make the 5 rupees of interest payment. But PP will be worth the same 95 only. This will take some time to absorb, but remember that. The PP values will always be the same. Whether you take the loan and interest or you don't take the loan. The only thing is interest would change. If you take the installment payment, then in chroma example, 2 and 2, 4,000 will be interest. Here, I think 3.31 and 1.68, 5 rupees will be interest. But PP will be at 95 only in both the cases. Are we clear with this? Any problems here? No? Okay. So this is regarding your PP. We'll stop for around 10-15 minutes. And then we go to the subsequent parts, subsequent expenditure, subsequent evaluation. Today we can try to finish those parts. Yes?